So let's say you've decided to become an investor and an active investor at that. You now have a choice whether you want to be a trader, that is looking at the short term, usually looking at technical analysis, or are you going to be an investor, which is usually long-term investing in stocks using fundamental analysis. And Cayden's here with us from Value Investing Academy to tell us a little bit more. Firstly, the whole value investing theory, I suppose, all rests on the shoulders of one man, Warren Buffett.
Yeah, Warren Buffett. Yeah, exactly. So he made, in fact, value investing very popular.
What underlies, what are the fundamentals to his investment strategy?
Okay, if I may introduce value investing, I may share in three forms. In other words, the AAA methodology. Now, the first A would be, I'll name it as assessing a company. The second A, I'll call it acquiring a company. So after you assess a company, the next thing is you want to take over the company, to purchase a company, or acquire a company. Now the third one is eventually when you acquire companies, you want to build a portfolio. So I call it an asset portfolio. So AAA, assess, acquire, and building asset portfolio.
Right, and so let's take the first one in turn, because there are many ways to look at a company, aren't there?
There are many ways. In fact, there's a whole long checklist of trying to figure out what are companies that are good, what are companies that are bad. So what I may is, maybe I could share one or two important principles. Now the first one, if let's say we want to acquire a company, or rather assess a company, what we are looking for is we are looking for its profitability. Specifically, we are looking at earnings per share. Okay? So if I may, I could give one example, for example, a local public listed company called Osino. So if the audience is able to look at the chart, you'll be able to see that the earnings per share, in fact, is not so predictable. You know, in the early days, it was doing fine, and subsequently, it drops below. So it went down to negative.
Yes, and we see that there's a bit of a zigzag there on the chart, isn't it?
Yeah, exactly. So in comparison, if you look at Viacom, if you look at the trend, it's actually on an uptrend. And it's pretty consistent. So if you put two companies side by side and if you are given a choice, most people would choose a Viacom instead. Why? Because the earnings per share is in fact very predictable. So it's important for us to find a company in which the earnings is predictable so that we can actually sleep peacefully at night.
Right, so this is very much a quantitative look at the company's earnings, isn't it? Because you're just looking at the data. Yeah. What are some of the other, perhaps more qualitative ways of looking at stocks? Okay,
for example, the qualitative way, there are a couple of things. The first one, we are looking at, for example, the economies of scale, which is, some people call it the low-cost producer. Now, this one is important is because in the world of capitalism, whenever some companies see another company doing very well, most likely they're going to copy and then they try to duplicate the menu and so on. Maybe they want to compete. Any business owner who started a company, what they want to do is they want to fend off competitors, so that they can survive in long run. So in order for them to fend off competitors, they need to have an edge over other competitors. So Warren Buffett called it a durable competitive advantage. So it's not only just a competitive advantage, but this competitive advantage must be highly durable. So I may give some example, let's say for the low-cost producer. So if you look at the local, let's say the hypermart, you can see Sheng Siong, you can see NTUC, you can see, let's say, Giant and so on. And in the United States, you can see Walmart. Yeah, so I would consider such companies having a great economy of scale because they can purchase huge amount of goods at a very low price. As compared to, if let's say me, I'm going to start a provision shop next door. There's no way I can compete with a giant hypermart like them.
Yes, because you simply don't buy the volumes that the supermarkets do.
Yeah, exactly. So in due time, it's a matter of time that a small shop like me is going to just go off. So it's very important for companies to have certain level of competitive advantage.
But sustainable too, and that's the important thing, isn't it?
Exactly, sustainable too. So the next one I may introduce is actually called brand loyalty. Now some people, they confuse between brand and brand loyalty. For example, certain companies may have certain brand. For example, let's say BMW may have certain brands or Mercedes may have certain brand. But it doesn't necessarily mean that the clients or the customers will go back and buy the same thing again and again and again. Yeah, so
they might buy a BMW one year and a Mercedes the next.
Exactly. So the key thing for brand is to create this stickiness where somehow unconsciously the client will go back and buy the same product again and again and again. Now I just share one personal opinion or my observation is actually this company called Bread Talk. Now last week I went over to Sentosa and I came across this restaurant called Ding Tai Fung, which is a Chinese restaurant. So I was very surprised that the queue was extremely long. Yeah, so the next day when I went over there again, the queue was still very long. And then if I visit their, let's say, the coffee brunch, which is the toast box, somewhere near my house, every single evening I will see the same customers over and over again, and the faces will be very familiar. So interestingly, a couple of walks away, there's a coffee shop, but they refuse to visit the coffee shop, but they're willing to pay a premium for the same cup of coffee at Toastbox. So I find this is pretty amazing. So in that sense, I find that there could be, most likely, there's some form of brand loyalty or stickiness in terms of customers going back to Toastbox and then purchase their cup of coffee again and again and again.
It's hard to measure though, isn't it?
It's hard to measure, which is why it's called qualitative. That's why you need numbers to actually justify our opinion or belief that what we believe is actually true, which is why you need to look at the numbers.
And the other thing that Warren Buffett keeps talking about is making sure that the company has a competitive advantage through and a defensible one that isn't so easily copied, for example, through patents.
Through patents, for example, it can be patents, can be trademarks, and it can be even secret recipes. For example, KFC secret recipes. Another one very popular will be trade secret. For example, Coca-Cola. Nobody knows what is really a secret recipe of Coca-Cola, and of course, just now I was talking about KFC. And other things, it could be, for example, high switching costs. Now, for me, I personally don't really use Apple. I'm not a fan of Apple, so I use Microsoft Windows. So if you ask me to switch from Microsoft Windows to Apple, I mean, this is like tearing me apart. So I find it's extremely difficult. So I'll prefer to stick to a Microsoft Windows. So to me, for me to switch from one brand or product to another, it's really very tough.
Yes.
Yeah, exactly.
All right. So we've got some of the quantitative earnings per share you've mentioned. We've got some of the qualitative measurements as well, such as brand loyalty and I suppose also some of these trademarks and so on. What are some of the other ways that you need to assess a company before you then move on to actually acquire it?
Okay. So once we've done with the qualitative, we need the numbers to justify our opinion or thoughts. And just now I mentioned about the earnings per share. And the other criteria we can look at is actually this thing called the net margin. So net margin for people who are not with an accounting background, what it means is simply taking the revenue minus away all the expenses, and whatever is left, you have the net income. So you just get this net income as a percentage of revenue, you just get the net margin. So in short, whenever we run the business, we want the margin to be as high as possible. So if let's say the audience may look at the chart, you may see, let's say, 3 companies. One is we're looking at, for example, 800 Super Holdings, that's number one. The second one is Khong Flour Milling. The third one will be Singapore Airlines. Now, of course, Singapore Airlines is something that we're very proud of, Singapore girls and so on.
Yes.
Yeah, but it's
very
not
proud of them.
Yeah, exactly. So when we look at companies, it's not something that is really fanciful on our side, but what we want to see is the company is really making money and is making money consistently.
Consistently. That's the difficult part. You will see that on the screen, right, with the different companies.
Yeah.
Singapore Airlines might have a very good brand, but the margins are, I suppose, consistently low.
Yeah, consistently low, consistently flat. As compared to, for example, if you look at 800 Super Holdings, you can see there's a slight dip over there right in the middle, but you can see that the chart is actually going up. Yes. And Khong Guan is like is up and down, so it's hard to predict.
Consistency, though, with net margin is always difficult because on occasion you have higher taxes, for example, or finance charges, which aren't really necessary to do with the business, get factored into the bottom line and therefore the net margin. Why the net margin and not, say, the gross margin, where you're just taking revenue minus costs?
Actually, we can look at a couple of things. One is we can look at the gross margin, we can look at the operation margin, we can look at the net margin as well. Now, for example, if you look at the gross margin, a good guide for investors would be something above 40%. So if they're able to find a company that has a gross margin of 40% or more, or even is consistent, I will consider that that company has certain form of a durable competitive advantage. And you can even look at just now the operation margin and net margin. Now, if out of these 3, what I will do is I'll look at 3 as a whole. Because ultimately is, depending on the company where they operate, we are looking at the final bottom line, which is actually the net income. So net margin, in fact, is very important. But unfortunately, you'll be affected, like what you say, for example, currency fluctuation. If let's say we look at Coke. Now, Coke may have a very high gross margin, so their net margin is not so good. Yeah, so in other words, if let's say the investors is looking at the company, preferably they look at all. The gross margin, the operational margin, and net margin. So if they see some discrepancy, what I may suggest for them is actually to look at annual report. What causes this discrepancy?
Yes, and to look at it over time again.
Yeah, exactly. So so that the discrepancy is because of some other factors that the company cannot control versus is something got to do with the company.
Yes.
Yeah.
Okay, so we've done our assessment. We've now decided, okay, we now have the candidates that we are looking at acquiring. What's the next step then before you click buy on your trading account?
So assuming the investors have really shortlisted a couple of companies, the next thing is actually to look at the price. But the most tricky part is most people don't really know what's the price. You may hear people saying like buy low and sell high, or buy high and sell even higher. But the question is how low is low and how high is high. So not many people know. So in other words, for us to really acquire any companies, we really have to estimate the intrinsic value of the company using ratios or using certain other valuation methods such as discounted cash flow and so on.
Yes, and you've got a couple of other ones on the graphic there.
Yeah,
price
exactly.
to earnings ratio, price to book ratio. Give us some guidance as to how to use these.
Okay, for example. Okay, so if let's say we're looking at the first one, the PE ratio, or some people call it price to earning ratio, we're looking at something like less than 15.
Less than 15?
Less than 15. Right. But this is really a very blunt guide because what we need to do is specifically we need to compare the PE ratio of that company with other companies in the same industry. So what you want to do is you want to pick something that's less than 15 as the lowest as possible.
Yes.
So that's price to earning. But the setback or the disadvantage is as the PE ratio implies, that ratio only consists of two components, which is the stock market price, which is the price, and then the earnings. So it's not really that accurate because there are only two variables. Yeah, which is why it's really a rough guide.
And that's why you should also look at price to book ratio,
Exactly.
and discounted cash flow.
Exactly. So for the price to book ratio, you'll be very useful if let's say you're looking at companies with very heavy assets. For example, property related companies and so on. So that means, in other words, they make money purely out of their tangible assets. So that would be good if you are able to buy a company with a price to book ratio of less than 1. Yep. So that's the ideal. And in circumstances where it's very difficult to find something that's less than 1, you may look for something like, for example, less than 1.2. So less than 1 would be really ideal. Less than 1.2, I will still say that it's really a very good buy.
I guess there is a level, though, at which the price to book ratio is so low and the price earnings ratio is also so low that you kind of wonder, what's wrong with this company?
Yeah, exactly.
Why is it that, let's say price to book is at 0.3.
Yeah.
In other words, you're getting $1 worth of value just by spending just 30 cents.
Yeah.
And the price to earnings ratio might be 5 or even less.
Yeah.
Isn't there a case where you then have to say, hang on a minute, this is too good to be true? Exactly.
So there are certain circumstances like what you say is too good to be true. That's when the investor need to really look at the annual report and what causes the PE ratio to be extremely low, and as well as the price to book ratio as well. So you really need to go inside the detail and look at the qualitative part and what causes the drop in the PE ratio and price to book ratio.
Yeah. Let's say though, Cayden, that you've now decided that you've got your candidates of the companies that you want to buy.
Yep.
You then look at the ratios and you think, okay, that's okay. It's below 15, maybe even below 10 on a PE basis, and price to book ratio is below 1. Does that mean that you strike straight away, or should you find other ways to time the purchase?
Okay, if it's for property-related companies, for me, what I'll do is I'll really buy the company. If the price to book is really less than 1 and the PE ratio is really very low, or less than 10 or less than 15. That'd be one good thing.
So you wouldn't wait 3 months for it to fall further, for example?
No, I won't. So so in other words, the ratio that we use, whether it's PE or price to book, it creates like an invisible line. So in other words, what we want to do is we want to buy a price that's below this line. Yeah, because nobody in the world is going to know how is it going to fall further or is it going to rise.
Yes.
So in other words, any point in time it falls below that line, which is the intrinsic value, we actually have an opportunity to buy it. Yeah. So the most difficult thing in acquiring a company is not really the buying part, because once you determine the intrinsic value, for example, let's say $2, 190 you acquire, 180 you acquire, and so on. The difficulty is not determining and acquiring. The difficulty is after acquiring, does the investor has the ability to stomach the ups and downs? For example, if you acquire a company at let's say 180, then the very next day it becomes 170, and the very next day it goes up to 160 and 150. So what would the investor do?
Buy more, hopefully.
Yeah, exactly.
I mean, if it's a good company, then it's getting cheaper by the day, right?
Theoretically, it makes sense to just buy more. We are discussing here is buy more. But in real life, if let's say the person is using his hard-earned money, now the person will start to behave a bit irrationally. They start to wonder whether their valuation, whether is it correct or not.
Yes, did I make a mistake?
Exactly,
right?
Yeah. So if they see, like for example, 99% start dumping their stocks, they may start to wonder, the valuation, the PE 10 is right now, and they may do silly things. Yeah, exactly.
But if you did your homework well, I mean, if you got all the ratios right? You did all the assessment by price to book, you've read the annual report, you looked at the cash flow.
Yeah.
Should you really worry if the stock price falls further?
Which is why when you look through our numbers, whether the qualitative part or the quantitative part, the best is if the investor has acquired a company, stop looking at the stock price. I mean, that's one way is really not to remind themselves about the emotions that's being involved so that they won't do silly things.
Right. And then at what point do you then look at the stock price in order to liquidate your investment?
Maybe during the quarterly report, or the annual report. Because what's most important is really not to look at the price. And what's most important is to look at the value. And the value of the company you can only have a feel by looking at the numbers.
Yes.
Which is going to appear every quarterly and of course the annual report.
Because it's disclosed what the value per share is
Exactly.
and so on.
Yeah, exactly.
And so does that mean that, let's say you go on SGX Stock Facts, you've looked through the companies, and by the way, there are quite a number of companies that are priced below book value,
yeah,
about
exactly.
350 companies. Yeah. Does that mean you buy them all?
Okay, one of the key things which I did not mention is really assuming that it passes all the qualitative checks, it passes all the quantitative checks. Now we have to ask ourselves whether is it a company that is really familiar with us. For example, in Singapore, there are a huge number of companies. We're talking about like 700 to 800 companies. In US, there are approximately 3,800. But no investor in the single world knows every single company.
Yes.
Yeah. So in other words, the investor has to be very comfortable with the company that he or she is looking at after they have passed all the checklists. Now, maybe I can give an example. If you ask me a company like, let's say Bread Talk. Now, for a layman like me, it's very easy. I go down the street, I look at the restaurants and so on. So most people, investors, will understand how they operate. It's very simple to understand.
Well, we just have to look through the glass window and we can see what they're doing inside, right?
Exactly. So if you look at something like, just for my own perspective, let's say you look at something in the shipping line, in the oil and gas. You know, we're talking about oil and gas, very low, prices very low. But you ask me to buy, even though they may be undervalued, I'll be worried. Because it's something that even though I can read the annual report 10 times, I may not understand.
Yes, and even Warren Buffett says he only buys companies that he really understands the business.
Yeah. So this is very important is so that the moment we understand the company, we have very high conviction, we have very high confidence. And the confidence is being added on by the qualitative checklist, the quantitative checklist, so that we can sleep peacefully at night. Now this is very important, I call it the sleeping test. Now, the moment we invest in company, we are able to sleep peacefully, then we will not be able to make irrational decisions.
Yes.
Yeah.
You mentioned property companies earlier on, which actually do tend to trade below book value because of the long cycles that they're able to earn their cash back from putting up the building. And besides, a lot of people actually are already very heavily invested in property through their HDB flat or their condominium. So how much should you pay attention to what the company actually does? Not just for familiarity, but also simply from a portfolio management perspective.
Okay. So if let's say we look at a portfolio, before we look at what the companies we need to buy and so on, we have to really understand ourselves. Let me give an example. Let's say I have friends who works a very busy schedule. For example, every day they work like 12 hours a day. So if let's say their schedule is so packed, they need to spend time with children and all this, they practically would have very little time for them to run through all the lists, go and spending so much work, investigating company and so on. So for people like them, what my suggestion is for them to be more passive or less active in a sense. So in other words, they should spend lesser time on attempting to investigate and then learn about looking for companies and so on. So Benjamin Graham, which is the father of value investing, which is the teacher of Warren Buffett, he said that there are two extremes, two spectrum of investors.
And we see them on the screen here.
Exactly. So you can see on the other end is known as the passive investor, or some people call it the defensive investor. So the other side is called the enterprise investor or active investor. So if you look at some of the expectation of the defensive investor, you can see defensive investors tend to look at, they want a stable return, they don't want to spend too much time, they have the attitude of I don't know and I don't care. So if somebody asks them, what is the stock price? I don't know and I don't care. So if people are so busy with their own schedule, they might want to get towards the defensive and passive investor. So if let's say that's the case, then the portfolio structure, as a rough guide, will consist of 25% of cash, and the remaining could be fixed income, it could be bonds, it could be ETF. Something that they don't really need to spend so much time in. So 25% and the remaining 75%. And if you move the bar to the other extreme, which is on the right-hand side, you can see that if you want high return, if you're not happy with, let's say, STI ETF, 78%, you want high return, then you need to actively look at good companies at undervalued price. So if you look at this case, the backup cash is almost the same, which is 25%, whereas on the other hand, 75% will be stocks or equities. Yes. But this one requires really much more effort as compared to the passive investor.
Yes, and I noticed too that this chart, you're not at 0 or 100. You're actually in the middle somewhere. You've got a weighting towards one or the
other.
You're tending to be a defensive or you're tending to be an active investor, but you're never fully active or fully defensive.
Yes, you can say that. So for Warren Buffett, for example, his portfolio will be approximately 25% backup cash and another 25% in bonds. And the remaining 50% will be in equities. So I'll consider him as really a very active investor.
Yes, even in the 50% equities.
Yeah, exactly.
Still already very active.
Yeah. And some people are asking me about why is there a 25% cash? Shouldn't we just dump everything in the stock market and make tons of money out of it? So the 25% of backup cash is actually to prepare for an opportunity in case if there's a crisis that comes. So this cash is ready for you to buy even more good companies at an undervalued price. So it's like a backup.
Well, thank you for talking us through the triple A's, and I suppose this is what you'll be talking about too on the 9th of May.
Exactly.
Tell us a bit more. What can people expect from your presentation?
Okay. So the presentation on 9th of May, what I'm going to do is I'm going to give more case study, and I'm going to go in depth into the triple A framework which I shared with you just now.
Brilliant. So you've got the preview, now attend the seminar, 9th of May. The website is on your screen. See you there.
See you.